We're recording this just after the autumn budget, which was last week, and here predominantly to talk about tax on farmers and the family farm tax. But ultimately, there was quite a lot in that budget, and we'll be releasing a number of different podcasts touching on the key points affecting business. But from a farming point of view, there were some changes, weren't there? But not too much. So I guess before we go into the detail, there is a distinct feeling now that this is happening next April, that the new taxes are coming in and farmers need to be wary of it.
Yeah, that's correct. I think there was a lot of scaremongering, a lot of media hype around the recent budget, and farmers were probably rightly concerned that more changes were going to happen, but they haven't. The budget is still quite damaging to farmers, and if we go back to October 24, prior to that, you used to have 100% relief on your farming activities. So your farming land, business assets used to qualify for 100% relief. And historically, farmers haven't given their assets away, mainly due to three factors. One of them is because you got an uplift in value when you passed away. So that would pass on to the next generation. There'd be no capital gains. You'd get the uplift in value if you ever sold it. It made sense to hold on to the asset. The second point is you derive an income from the asset. So the parents might not want to give the asset away because they might lose the income and they want it, care home fees, whatever they need. And thirdly, and sometimes the more emotive point, is the security of the asset. Worried about daughter-in-law, son-in-law, or that asset, the farm being torn up. You know, family farms have been ripped apart in the past, and they're worried about gifting those assets and to a younger generation. You know, maybe when they're more mature, they might. But those three factors are always why probably the father, grandfather held on to the asset so long, just because it made good tax sense and it made security of the asset.
I think that's a fair point, and actually that is relevant to any business, not just farms. Certainly that third point, and we talk generally focused around tax and what's best from a tax point of view. But ultimately, you're right. Quite often, a family will have more than one child, and one might be interested in the business, one might not be. There may be others, and actually, to split that asset fairly is an obligation that I think preys on the mind of parents and business owners and farmers quite significantly. It's not just that child number one is in the business and child number two isn't. Well, how do you split your estate down in order to be fair on your children and your family? So this kind of, I think what it really does do is makes farmers sit up and undertake some planning.
Yeah, I think it has engaged them in this process, not necessarily for the right reasons, and they've had to react to it. And you're quite rightly, historically, first son used to inherit the whole farm. That isn't quite the same as it is or has been in the past. But nowadays, the income derived from farming is not really a good return on the asset invested. Yeah. So there's not a lot of income to make in farming unless you're really big. Yeah. And therefore, if you try and split the farm up and try to make it equal in terms of assets, you probably haven't got enough income to go around. So you still have to be careful on how you divide up the assets and where they go. So planning is always needed.
Yeah, and I want to come on to that, talk about the main two or three options when it comes to planning, because some farmers I think have already embraced this and are talking to their accountants and advisors. Others, not so much. This is coming, this is happening, and people need to take action. So we will come on to that. But first, just a bit of a quick fire recap as to where we are at the moment. These rules haven't come in yet. So just to start off, Ryan, how are farms taxed for inheritance tax at the moment? So farmer passes away next week, leaves the farm to wife or children in his will. What's the inheritance tax right now if this happened?
So these changes, although announced in the budget back in October 24, these changes don't come into effect until we get to April 26. So from 6th of April onwards, these rules change. As we currently stand today, if somebody passes away and we ignore the fact that there's a spousal exemption, so they go to the next generation, there would be inheritance tax to pay on any assets that weren't relievable. Now, the relievable assets, which we're talking about agricultural land here, or it could be shares in a trading company, then they would qualify for 100% relief. Yep. So it doesn't matter if they've got £1 million worth of land, whether they've got £10 million or £100 million, agricultural land would have got inheritance tax free. Yep. Roll on past 6th of April, and we look at somebody passing away then, again, ignoring the spousal exemption, they are capped to £1 million relief. So that 100% relief they got is going to change, and they will only get £1 million at the 100%. The remainder would then fall under a slightly new tax rate, which would be half the rate of what inheritance tax was. So it was 40% for anything that wasn't relievable. It will now be 20%.
Yep.
But a cap of £1 million, that's the important part. So somebody who has an estate or farmland worth £5 million passing on, only that £1 million would have been knocked off.
Yep.
The remainder would have been then taxed, ignoring nil rate bands and other things that we have to nuance in there.
Yeah, so 5th of April next year, the new rules come in. So right now, that £5 million farm moves to the beneficiaries of the will, no inheritance tax, and they inherit that at a value of £5 million. If they were to sell it for £5.5 million next year, they would make a £500,000 gain and pay tax on that
Yep.
figure. New rules that come in. Farmer owns the farm himself, passes that £5 million farm on in exactly the same way. The first £1 million is relievable. £4 million is taxed at 20%. So £800,000 worth of tax that farmer would need to find for the exact same transfer to their children in their will. That's what we're saying, isn't it?
That's right. There are factors that will affect this, such as that £1 million cap. Obviously, each spouse would have that £1 million cap. So provided you structured your wills correctly, which we've done prior to the budget with a lot of clients, then they would have been able to maximise that inheritance tax relief. So they could have had £1 million each.
Yep.
What wasn't announced until we had the budget was that this £1 million was transferable between spouses.
Yep.
So originally they said it wouldn't be. So we've done a lot of planning in making sure that we were leaving a certain amount of assets down to the next generation on first death. They've now done a U-turn, changed their mind, and they're now allowing, which is sensible, for that to be transferable between spouses. So provided you are married, obviously it doesn't have the benefits if you're not, you will be able to transfer that £1 million on death. So £1 million plus the £1 million, £2 million plus your nil rate bands.
Yep.
The chances are that you can get, well, ignoring the resident nil rate band, but somewhere between 2.65 million and £3 million off your estate.
Yeah, because that transferable allowance was common across, as you say, the normal nil rate band and the additional residence nil rate band, in that all of us have this available to us, in that the first person passes away of a married couple, their assets can go entirely to the spouse, and the allowances go to the spouse as well. So when the survivor passes away, the second death effectively, under normal inheritance tax rules, yes, all the assets that go to the children are subject to tax, but there's double the amount of relief that come off that as well. And it was interesting when this policy was first announced last year that first £1 million wasn't transferable, and that felt like an oversight. And I wasn't really surprised that they brought that into the budget. It's just a shame that farmers had to wait a year in order to get that benefit. And as you say, you've been proactive and undertaken planning with farmers who have been working around that in terms of, my will now needs to say the first £1 million worth of value needs to go to my children and the rest can go to my wife. That's now not necessary, but people who were trying to get at the curve, I guess they've spent a bit of money on wills that now appears unnecessary. Not that updating wills on a regular basis isn't useful, because I'm sure other things come out in the mix of that process, but that's the important change in Budget 2025, isn't it? That the strategy of leaving the farmland to the spouse, the survivor, and that survivor then getting £2 million of allowances will probably now be common strategy.
Yeah, and I suspect if you look at most of my client base, I expect probably 90% of them probably have a very simple will in which they leave everything to one another. So the surviving spouse inherits everything, and then it's then passed on to the next generation. There are some caveats and some bequests in there, but generally speaking, that was how it was structured. So probably, depends how old the will was, it probably didn't need to be changed, provided the the £1 million rate was transferable. Yeah. So the budget has helped that, but we have done planning, which I wouldn't undo, because it's still sensible planning. It still does the right thing.
But otherwise in the budget, before we just move on to the main areas of planning, no changes in terms of the £1 million threshold coming down, no changes in terms of the percentage, no banding, which there was a lot of interest in. And I've talked about on this podcast before about having a lower tax charge for smaller farms and potentially a higher tax charge for those landowners that are utilising reliefs on farmland. That was untouched. So ultimately, someone who's getting into farmland to save inheritance tax, albeit used to get 100% relief rather than paying 40% tax, is still getting half the relief that they used to, whereas small farms that actually really did need that relief to pass this on without having to find the cash, that remains unchanged. So this new tax is coming, and it will be worrying for small farmers, won't it?
Yeah. Some of the worry was about potentially having some changes to the gifting. So there might have been a cap on the amount they could have gifted, which certain gifts, which we'll come on to, can be held over and no capital gains at that time. So that was what a lot of the activity was done pre-budget, because there was nervousness about changes to those rules. But that remained unchanged.
Yeah, excellent. So let's move on to talking about planning option strategies for farmers here. And I think we'll try and simplify it, but quite often the solution needs to be personalised and tweaked for each individual case. But what we'll look at are the two main policies as a starting point. One is to gift your farm away in lifetime, and the second is to hang on to it and what happens from the tax point of view. So strategy number one, farmer starts to give their farm away during their lifetime to their beneficiaries, their children, the people that are working in that business longer term. From an inheritance tax point of view, if they give that farm away either now or after the 5th of April, I think the rules are the same. No immediate charge, but you're not escaping inheritance tax immediately, are you?
No, that's correct. Yeah, there's no immediate charge. Most of the assets that you want to pass on, not all, but most of the assets involved with farm and the farmland, that can be passed on without any capital gains tax. So that would be the problem, passing that on and getting triggered on a capital gain. Mm-hmm. If a capital gain was triggered and then you died within this 7 years.
7 years, okay.
There would be a problem, because you could get double taxed effectively. So what we looked at is what we would give to the next generation. The problem with that is, obviously, all you're doing is kicking the can down the road. You're passing on to the next generation, depending on their age and their survival. So you need to have some careful planning and thoughts what happens to that younger generation, God forbid. Mm-hmm. So we need to look around whether there's some life insurance policies or something to cover them, their spouse, the children, etc. The other thing is with passing on the assets to the next generation, as we mentioned earlier, was the security of the asset. Mm-hmm. So although it might be the right thing to do from tax, the emotive reasons might suggest it's not the right reason. So there are other means that you could still have security of the asset by using a trust, for example. And we could pass on assets through a trust, beneficiaries being those named, and that just adds a bit of security. I mean, God forbid the son passes away if the assets are passed to him or her, and the surviving spouse goes off, finds someone else, has other children. You know, you want the grandchildren effectively to inherit from the deceased son or daughter. So a trust does help with that mechanism in securing that asset for the future generations. Yeah,
understood. So I think the key points with this strategy, gifting the assets away either via a trust, which is, so a trust is almost like a holding pen for the asset to go to the beneficiaries at a future date when they're ready. But I think the key points here from an inheritance tax perspective, no inheritance tax when you gift the farm away, but if you die within 7 years of the gift, there is tax. First 3 years at the full rate, and then it starts to taper down towards year 7. We were half expecting that 7-year window to be extended, and it wasn't in the budget. So that's is important, that give the farm away now, survive 7 years, you've avoided the inheritance tax.
Yeah.
From a capital gains tax perspective, you can hold over the gain, which means if you sold the farm, you would, what am I selling it for? What did I buy it for? There's a gain, I'll pay tax on it. And for some gifts, the same formula kicks in, but you look at market value versus original cost and pay the tax. You're not caught by that. You can hold over the gain, so effectively no capital gains tax on the transfer. But you touched on the important point, I think, when it comes to capital gains tax earlier, is that there's no uplift to value. So in our hypothetical £5 million farm, under this strategy, if farmer who owns it at the moment initially acquired that for £500,000, either bought it or inherited it from his father, it's now worth 5 million. Gift that to children now, fine. Survive 7 years, no inheritance tax. Hold over the gain, no capital gains tax. We're ticking the boxes here. But if children then in the future decide to sell that farm, say it's then worth £6 million, they're not paying tax on the difference between 6 million and 5 million.
No.
They're paying on it between 6 million and the £500,000 that father acquired it at. So that, I guess, is raises discussions amongst farmers and family members as to what are the intentions of the beneficiaries. And that, I think, is, if you're young enough, you can entertain this policy quite freely. But But that is a key point as to what happens next, isn't it?
Yeah, I think back prior to the budget in October 24, I think there was a lot of noise about IHT was going to change. So inheritance tax was going to be more detrimental. Now, if I had a crystal ball, I would have thought that the uplift in value on death, that capital gains that gets wiped out, I thought that would have been the thing they attacked,
right,
and took that out. Therefore, the family farm, as long as it was farmed within the family, generation after generation, there'd be no inheritance tax. But when that farm was sold, when that money was realised and they had the cash to pay the tax, they paid the tax because they wanted to get out.
Yeah.
And that was the point. That seemed like a logical, you might argue whether it's a fair solution, but the money's there, you've come out of farming, so you've realised the gain. They didn't attack that. They obviously went much further than that. So now you do have to seriously consider all those factors that we talked about.
Yeah, yeah. But we are in a place here, if the farmer is young enough, that they can undertake this strategy, and as you say, survive 7 years, hold over the gain, and tax only crystallises if the farm is sold in the future, at which point there is cash to pay the tax. Okay, so this is, option one, not in terms of the best option, but the primary option I would say for younger business owners and younger farmers. Yeah. So option two, taking it to the other end of the spectrum, is the do nothing approach, really, which is to continue to own the farm right up to death, pass it on in your will. We touched on, the survivor of the two husband-wife partnership there, sort of passing it on to children on death. So from inheritance tax point of view, just recap on our £5 million farm, there would be tax due at this point, wouldn't there, on death, inheritance tax?
Yeah. Again, I don't want to keep rolling back to October 24, but when these rules got announced, we looked at whether assets should be passed on to the next generation. How do we get around this inheritance tax problem? And we had the same issue then, that we had a year and a half in which this became effective. So for that period in time, if somebody passed away and there could be in the future inheritance tax, there wouldn't be. So you had a dilemma whether you looked at making the gifts then, when you start the 7-year clock, depending on their age, or did you wait a year and a half and try and be clever, and if I still survive, I'll do it then. You're a year and a half older, so the 7-year clock is a lot shorter then.
Yes, right.
But in the meantime, if you had passed away in that period, you would have got the uplift in value rather than passing the assets on like we discussed. So if we look at the farm where they don't do anything because they thought, well, I'll wait a year and a half, and they think, well, I can't gift now because 7 years is not achievable, there is going to be problems with that farm. They're going to come under the new rules. They're probably going to get somewhere between £2.5 and £3 million, taking all the factors in, the marriage and everything else. The rest of it's going to be taxable, unfortunately, at a lower rate. But that family farm could have £500,000 to find from somewhere. And where do they find that? The income that they generate from a farm, with subsidies being cut back, commodity prices, input costs higher, a real struggle at the moment for a lot of my arable farmers, and where they go from here. So to try and then find further funds in their cash flow, which they're already stretched to pay an inheritance tax liability, will be catastrophic for them.
Absolutely. And I think it will obviously lead to land being sold, and probably a new industry of people buying up farmland that has potential, or people lending against it. We will see where that one goes. So importantly, Ryan, in this strategy, which I'm not saying that farmers should just do nothing. I think you take this option after careful consideration of the others, but this isn't necessarily the wrong option for some farmers, and I'll come on to why that is. But if you die and pass on the farm in your will, inheritance tax will be due. So every owner of that business, let's call it husband, wife, has £1 million, they're transferable. So first 2 million is relieved on our £5 million farm that we're talking about here. £3 million is charged at 20%. So there's tax defined of £600,000 on death. The farm then moves down to the next generation, to the beneficiaries of the will. From a capital gains tax point of view, no capital gains tax on death. So we're talking about just inheritance tax. And the uplift point that you mentioned is achieved on death at that point, isn't it? So the beneficiaries receive the farm at a value of 5 million. So they sell it for 6 million in the future. Their gain is now £1 million, whereas in our previous example, it was a lot more. And I think that is potentially important, isn't it? Because it's easy to assume that, well, we don't want to pay the inheritance tax, so we'll go down the route of gifting and passing on and holding over gains. But actually, if the intention is to sell that farm at some point in the future from the beneficiaries, then potentially paying your tax on death at 20%, but getting that high uplift so that the capital gain when the beneficiaries do sell that farm is so much lower could potentially be the right option for some farmers.
Yeah, it could well do. You'd have to look at when the land was first acquired, when it was first inherited. We're looking back at March 82 values, if not, which are relatively low for agricultural land, and the uplift in value could be huge. And if the intention is to pay it, the only thing I would caveat that with is obviously if there's readily available funds to, first of all, pay that inheritance tax liability. But that could be worked around with some life policies or something, depending on the age and premiums and etc. But you're dead right. Yeah, you've got to look at the rate of tax at capital gains over the rate of inheritance tax, and which would be the better to pay.
Yeah, so it's almost choose to pay inheritance tax at 20% on anything over 2 million now to save a decent amount of capital gains tax down the line, or you go down the route of paying no inheritance tax, but knowing full well if you do sell the farm, the capital gains tax, well, we know the rates now, but they could be unknown. They are subject to change. So there is a little bit of certainty being brought in there. But again, we come back to the point you mentioned in the conversations you're having with your clients is you need to understand what the intention of your children and their children. Because if the intention is that your family will continue to farm this for many generations to come, then you wouldn't choose to pay the inheritance tax. But if there is the strong possibility that it may be sold at some point, then this isn't an option that should be discounted, is it?
And we're predominantly looking here at partnerships, unincorporated businesses.
Yeah.
This is traditional of a family farm. It's always been in a partnership. There are some that operate in a corporate structure. So we've got shares and we haven't got land and values, but we have got the valuation of that company and then of those shares, minority discounts, etc.
Yeah.
So there are potentially tax planning options that you could do with a limited company or by creating a limited company. But there are factors you need to consider in that, you know, when the inheritance have happened, what the values were, what's going in. So it's right to be speaking to advisors such as ourselves to look at these options and what is best for you.
And just thinking this through to its natural conclusion, we've kind of taken the two sort of strong options in either direction, give it all away or hang on to all of it. Then there must be a middle ground here. When we're talking about this hypothetical £2 million allowance, there must be some kind of middle ground whereby, you know, in our example, you give away £3 million worth of the farm now, get that 7-year clock ticking, hold on to £2 million worth of it, continue to draw income on that. That may, in a different scenario, give you control of the business still, knowing that is protected from inheritance tax under the reliefs on death at £1 million each. So almost like a split strategy, staying involved in the business but passing some on early. Are you seeing that at all, or is everyone kind of going for option 1 or 2 here?
No, every option we're looking at is considering that relief that's still available, that £1 million for each spouse. So if the family farm's worth 5 million, if it's worth 10 million, we're probably getting rid of most of it, but maintaining that 1 million because we're still getting the uplift on death.
Yeah.
So it makes a lot of sense to hold those in your estate. It gives a bit of certainty to the next generation because you're passing the assets on, something we haven't talked about for them 3 factors we mentioned at the very start. So most of the time, well, I think in all my cases that we've looked at so far, we have maintained that both the spouses will hold on to those £1 million reliefs. Son, daughter, whoever the next generation are being passed the rest of the assets. That makes the best sense from a capital gains point of view with the uplift in value, but also inheritance tax planning.
Yeah, so you're utilising that £2 million in this scenario, that £1 million each relief, and what the beneficiaries receive on that strategy is the capital gains tax uplift. So in this £5 million farm, 3 million of it, if they do sell it in the future, will be basically valued at the original cost for the parents, but 2 million of it will be at the valuation at death. So there's a bit of a mixed capital gains tax calculation there, which is better.
And just as we touched on earlier, we talked about one of the reasons being that you need to maintain an income from that asset. Obviously, if you pass assets away, you can't continue to benefit as you did before.
Yeah.
So you do need to consider what you're taking from the partnership going forward. If you're reducing your asset, you need to be thinking about how I affect my income. What do I reduce to make sure you get around this gift with reservation of benefits?
Yeah.
So there's a lot of things to consider. It's not just I'll do this but carry on doing that. You need to take all these factors in and make sure you're comfortable on what you're gifting away.
Oh, it's massively emotive, isn't it? When you think about it, this is a family business in the truest sense, and this is not just an asset that has been owned for a period of time, income generated from it, sell it and move on and do something else. This is a lifestyle of multi-generational family, and something that's just always been the way. So in terms of the threats to this model, they are significant, but ultimately the message from us is to take advice and understand which blend of strategies are right for your family and do something about it now. Because, of course, whilst the policy doesn't come in until April next year, the fact of the 7-year clock starts ticking on gifts, that came in on budget day 2024. So you're thinking you can give the farm away before April and you avoid all this. No, that's not the case at all, is it?
No, that's not the case at all. I think planning needs to be considered, and you need to be comfortable with what you've made. If you decide to hold on to the asset for the reasons we talked about before, there's no succession, no one really that's going to take on the farm. It will be sold. So be it. We've got that. We might leave it to the surviving spouse, and then it will be sold. You're still getting the uplift in value from that share, but we might be looking at equalising husband and wife share. We might be looking at passing some of that asset away from him now. We might be. There's all a number of things. There's so much to comprehend. You really need to be sitting down with your advisor, going through your family charter, mapping out where you want to be in 5, 10, 20 years' time, and then making sure those pieces all fit into the jigsaw nicely as we move forward.
Yeah, absolutely. I think it's a really, really useful closing message. I think I would just wrap up by firstly saying that these rules do impact trading businesses alongside farmers, and that side of it has kind of been overlooked, I think, by the media in general, hasn't it?
I think it has. What you tend to find, though, is with those businesses is their assets are not huge. So they might lease a premises, or what they trade from is very small, but the farming have huge asset value and relatively poor profits. But in your case, if we are a corporate, which most of them tend to be in business and trading, they will have some value and built up funds over time. So there is goodwill and a lot of other factors in there. So the businesses can be worth quite a lot. And they are a family business, a lot of these. And you're going to have the same problem. The value of those shares are going to be, quite substantial. And trying to pass them on, you're going to have the same problems. But you have got a little bit more flexibility with a limited company structure on diluting ownership without moving vast amounts of land and trying to go through those titles and unregistered land, et cetera, et cetera. Not for the faint-hearted.
No, that's right. But the process of transferring is a little bit more straightforward with a share transfer document rather than, solicitors and conveyancing and all the rest of it that goes with farms. Yeah, fair point. I think, Ryan, I would just wrap up by saying that we have certainty now on this, and farmers should not be sleepwalking into a strategy here. They need to understand what the long-term usage of that farm is going to be. If the family will continue to farm this for generations to come, then looking at gifting in lifetime at a certain level, the 7-year clock is probably the optimum route. If it's likely that the farm will be sold at some point, this generation or next generation, then there is some more work to do there around hanging on to it at death, potentially getting the uplift or looking to crystallise that value sooner rather than later. But I don't think any hypothetical situation that we talk about results in, just see what happens. I think strategy needs to be considered, advice needs to be taken, and whichever mix of methods of dealing with this are right for each family need to be thought about now before April so that everyone knows where they are with things.
Yeah, the changes with the government have brought this to the forefront of every family farming or every business going forward, family business. So don't sit there, don't do nothing without thinking about the consequences. Do speak to people, do speak to us, make sure you're comfortable where you are going forward. You need to plan ahead.
Yeah, indeed. Thank you. Thank you for your time.
Thank you, James.
And I'm sure we'll touch on this again as it does come into interaction the sort of next April onwards, and I'll be really interested to see some more case studies and stories as to how farmers are dealing with this, and how the policy does start to come into force next April onwards. So we'll definitely do that. So thank you, Ryan.
Thank you, James.
Thanks everyone for tuning in. I'll be back next time with some more information on a different topic, but please do subscribe if you can, and looking forward to catching up then.